So thank you for being with us. We have with us people from the LP side with Mario, people from the private equity side with both Mario, who does co-investment, and Eileen. We have people from the debt side with Charles from White Horse, HIG White Horse, as well as Munir. And with people from the valuation side, which is part of the topic, pricing, valuation, and leverage, with Sebastian Perrault from IQEQ and Perrault Partners. So the key question is sky the limit, right? Is sky the limit? Or to frame it differently, what has pushed the valuation to this current stage, which is a high stage? What are the key drivers, and also where to set the bar? If you're winning the auction, are you the smartest person in the room or not? And how are you going to grow this company into the valuation? So maybe to start us with, we'll have the equity people, but Charles is very good at stats and is keeping metrics. So maybe if you want to give us a sense of what has happened in the last 2 years to open the panel there, and then we'll switch to the perspective of equity investors.
So in terms of numbers, if you look at the last set of LCD numbers that were published, on the equity side, so I mean, acquisition multiples are at record levels at about 14 times in Europe this year. And if you look at leverage multiples, they're also at record levels at 6 times. So that's, I mean, with regards to leverage, that's about probably a turn more than 4 or 5 years ago. If you look at acquisition multiples, that's actually 4 turns more than 4 or 5 years ago. So there's clearly been an inflation with regards to multiples. And so, yeah, I think the question is, the limit is a good one.
So the question is, were people underpaying and are paying the fair price, or are they overpaying, but maybe they'll grow the company on the way? What's the view of the equity investment? Mario, do you want to start? Sorry, Mario, do you want to start us with?
Sure, yeah, happy to. So it's indeed, you see, like there is a lot of price inflation, as Charles was mentioning. I think that's a consequence of you have a lot of dry powder in the market. I think there's the record fundraising here, also record in terms of M&A activity this year so far. So that, of course, then generates an inflation of prices across the board. I think we think when you look at different industries, of course, there is probably a bit even more inflation for COVID resilient assets, or assets that are in resilient industries like healthcare and technology, and yeah. So I think the goal, what we do when we look at the investment, I think obviously we look at the multiples, but we also have to look at all the dynamics of the industry, the company within that industry. You look at the cash conversion. Cash is still king, so that's important metric that we look at. The recurrence of the revenues, particularly in this in the last 12 to 18 months. I think one important thing that we have to consider is the potential recurrence of the EBITDA. So you have a lot of impacts of EBITDA on the EBITDA, of sometimes positive impacts, other times negative impacts, and you have to really be careful what would be that impact, or how the company will generate their cash flow going forward.
So if you remember 10, 20 years ago, it was probably 7 times EBITDA. Now it's 14 times EBITDA. Is it because the industry has moved from a buy, deleverage, and hold strategy to a build and grow and multiply, build operational efficiencies? Are you comfortable with those valuations?
So that's a very good question. I think we at Schroders Capital, we have a strategy where we usually focus, or we have a strong focus on the lower end of the market. So if you look at the stats, as Charles mentioned, I think there is clearly high valuations, but interesting enough, if you look at those stats on the buyout side in Europe and in the US, you see that there is still a very wide gap between the large caps and the lower end of the market. So what we have seen so far is that we always been focused on the lower end of the market, and actually in the last 12, 18 months, we have benefiting a lot from this strategy, and we see a lot of multiple expansion. So when usually we underwrite our cases, we never consider any multiple expansion. But what I've seen is that the companies, besides the companies, have been developing very well, top line at EBITDA level. There is also then a multiple expansion, and we had like the largest exits so far in the portfolio in the last 12 to 18 months. So companies that returned all funds. So that's something interesting. So I think it's obviously, I think we have to be careful, and particularly on the larger end of the market where we have the larger funds raised so far in the last year or so.
And then what do you think of the current market, and where do you draw the line?
Well, I think it's hard to draw a line. I mean, if there's demand and if there's money, the prices can always go up, but you have to remain disciplined. If you see an EBITDA is never going to grow beyond a certain point, or there's so many COVID adjustments that it's just not realistic and it's just assuming that COVID disappears tomorrow, then you have to say, okay, we stay disciplined, we're going to really evaluate what is this company and what can we do with it. And I know all the operational teams are very hands-on now. A lot of funds have also taken operational teams already over the last few years. And right now, some of them have had to withdraw processes at the early start of COVID and focus on these companies. They are coming on the market, so they've worked already very hard on making it COVID-proof. But there will be limits, and you have to see where can you take a company. I think in venture, what you've seen is that trend has been setting through, and there's funds from the US that are coming into the European market, which is driving up the prices, because the prices have in the US always been higher anyway. And I think there's a lot of room for growth in the venture market. And Europe was always a bit slower, but that market has been developing so much more with so much more talent, now more repeat entrepreneurs. So I think it's not a bad thing that these prices are coming up and coming higher. So we have to see where that can go.
And I want to introduce one of the drivers we mentioned when preparing this panel, which is, should we be backward-looking, like the most recent EBITDA multiplied by 7, 10, 14? That's past backward-looking EBITDA calculation, right? But more and more, the world is switching to a forward-looking. It used to be just Silicon Valley who was looking forward. Then more and more, New York and Tesla is on the New York Stock Exchange, not just the Nasdaq. So more and more, the calculation are forward-looking. Do you think it is part of what's happening, which is people not just looking at the past, but also at the future and the potential of the companies?
Yeah, I think people have, for the last years, already been looking very much forward. I think when you looked at the last financial crisis, a lot was still based on leverage, but private equity has developed enough that it's been focusing more and more about what they can do in the portfolio, and not just like how much leverage and how has the past been and how can I leverage on that. So I think that trend already set in quite a few years ago. But I think you still have to remain realistic. Where can you grow a company?
Do you want to? Yeah.
Yeah. But clearly, for the back forward versus the looking forward.
Yeah. Backward versus forward.
Yeah. It's clearly. It also depends on the type of the deal. If we are, looking at a buyout deal, you are more on the past EBITDA multiples and all that. And if it's growth, you are more in looking forward, anticipation of the future. It's, I mean, now we can see types deal type by types, and depending on the profile of the company. If you have a company with clearly a transformation plan, you are looking forward. If it's LBO, BIS, or TER, you are more looking on fundamentals on the company. So clearly, there is also on the market a strong competition, because there is so much money to invest, especially in equity. So we can see that the ratio between debt and equity clearly change now. We have more and more equity on deals, so it's a case-by-case discussion, I guess. Huh?
Yeah, and also for venture, you obviously don't look at EBITDA because these companies are too young. but you do want to look at other ways of valuing the company, and you still want to have some drivers that you base your decision on, unless you see such a completely new market that you think is going to develop, then you can pay more. There is always some kind of metrics that you still should be looking at, even if you look forward.
Mario, you've been a VC. Do you think private equity is backward-looking or forward-looking more and more?
No, I think so. I think firstly, first just to add a bit of what Sebastian was saying on the buyout side. I think it's on a case-by-case basis. It really depends. I think it depends on the company and the industry where the company is. And of course, you are more comfortable to pay a forward-looking multiple when you know that those revenues are, that EBITDA is secured already, right? It depends on the business model, if you already have some visibility on the revenues or not, and that gives you a bit more comfort to underwrite the forward-looking multiple. But I think you have to look at basically not only to one metric, but to all metrics at the EBITDA level, but also cash conversion, top line level. So I think you really have to consider, and then the fundamentals of the company.
One sentence one of you mentioned is, price is what you pay and value is what you get. Do you want to reflect on price is what you pay and value is what you get?
Who was it? Who said that?
I think it's Warren Buffett. It's Warren Buffett. I don't know if you guys overpay or not, but you know, and probably where I think this sentence is interesting is value is what you get, but it's also what value is what you do with the portfolio company. If you put the right strategic plan, if you put the right build-ups, the value is different. Also, you know, I think the over-reliance on EBITDA is bizarre. I'm the CEO of Leaders League, who organized this event. If I start a growth strategy, it will cost me a bit of EBITDA for a couple of years, but then the plateau of EBITDA just moves up. The potential of the company moves up. When launching Leaders League internationally, it cost me EBITDA, but the potential of the company is completely different. So that's where I think the over-reliance of the industry on private equity, on EBITDA, on the LBO side, should also get a bit of inspiration from the venture people who don't care about EBITDA because they're building it. I don't know if you want to reflect as a...
Yeah, I think the advantage with private equity is obviously that you have a longer timeline, so you're not public, so you can see where can I get it in 5 years, and you will obviously in the early years invest. That's also why you get a J-curve in a lot of the private equity funds. But I think at 5 years when you sell, you want an EBITDA because people are going to look at that when you sell. So you can invest at the start, but depending on the lifetime of the fund, at some point you will have to look at EBITDA because that's where the actual profit comes from.
Yeah.
Yes, I absolutely agree. I think EBITDA is still very important when you're talking about buyout investments, of course. If you talk about VC and growth, that's a different story. I think for a buyout deal, what we sometimes now do when we're underwriting our case, particularly more on the direct investment side, so on the co-invest side, what you usually do is that if we feel that the valuation is quite high, but you have a very interesting value creation plan, is that we build our base case and we underwrite the case with a bit of multiple compression at the end. And if, even with multiple compression, we still can generate an interesting return, that gives us a bit more comfort to probably pay a bit higher prices than in other cases. But I think that really depends on the value creation plan and how comfortable are you to underwrite that case and to get to the exit value that you want to underwrite.
So it's DCF versus multiple. Discounted cash flow. Are you comfortable with the future cash flow you can produce versus multiple, which is past-based, right?
Yes and not. Sorry.
Yeah, it's about figures, first thing, but it's about also the sectors. I mean, depending on the GP, if you know your sector, you know what you have to do. You know, for example, digital transformation and all that. So, if you have a deep understanding of your sector, you can set up, for instance, a buy and build strategy, and so you know how you will drive that deal, how you will create value, develop revenue, EBITDA improvement and all that. So, I mean, I guess, and I think now GP are focusing on very specific deals or sectors like health, education, but also we can see in the wealth management industry also in the past few months. So, you know, they know exactly what they have to do for the next months or years. And so they develop a strategy, they put in place a manager, and they develop, and that's why they would like, it's possible to buy at a very high multiple at the beginning, because you know that your growth plan is there and you will deliver.
Charles was saying that average EBITDA multiple are 14, but education is between 15 and 20, and then tech, sky is the limit. Yeah?
Yeah, I thought you made an interesting point, and I've seen it as well, where sometimes I've lost, for example, a transaction to someone who paid something on DCF basis. It made absolutely no sense, but it was a platform, and they could use the clients from those platforms for so many other services and so many other things that sometimes people can pay really up for something that becomes then part of a much larger strategy. So then you can't win, but it's what it is.
So driver number one is this tension between past-looking, forward-looking with DCF. The second driver of those pricing increasing is probably the liquidity that the LPs are willing to deploy. So maybe on the GP side and the LP side, debt side and equity side, how do you see the pressure to deploy in private market as opposed to the classic equity market, bond market? Can you tell us the dynamic you feel from LPs?
Yes, so I think as mentioned before, I think there is clearly a gap when you look at the market. So when you look at large caps versus the lower end of the market, and then of course you can argue how is the split, but when you look at the large cap, I think we see that pressure. You've seen the largest funds raised in the last 12 to 18 months, and those funds have to find good opportunities, right? So, of course, that then generates some inflation in the market, and that drives more competition, higher prices at the end. I think we try really to be more conservative and believe that on the lower end of the market, you don't have that much pressure to deploy, and the funds are rather small. So if you look also at the dry powder historically, it's been much more steady versus the large cap. So that gives us a bit more comfort around that. I think another interesting point is that we tend to back GPs where there is, we call the complexity premium, where basically you see or a sector specialization or a strategy specialization. So basically a factor that could be on sourcing, execution, exit, where the GPs can create more value and can be more competitive. And that also, I think, is something that mitigates a bit the competition, right? Because if you have, for instance, a highly specialized GP that only does healthcare investments, of course, that GP has advantages versus other GPs that is more generalist and probably cannot really understand well the value creation plan and cannot underwrite the case with as much knowledge as the GP that is more specialized. So I think that's an important point.
And Charles, do you feel this pressure to deploy money? I mean, HIG has been growing by leaps and bounds and has more and more cash to deploy. How this pressure influences you? Yeah,
I mean, liquidity is a fact, right? There's excessive liquidity today. The amounts of dry powder are, I'm a numbers guy, records high. So there's $360 billion of private debt dry powder today. So that's 30% more than 2 years ago. So it's a lot.
Chin.
Sorry. So, I mean, with regards to dry powder at HIG, we don't really think this way, right? Of course, we have investors like everyone who prefer having their capital deployed. I think at HIG, what investors are looking for is good investments first and foremost. So we don't have pressure to deploy. Our investment committee has made it extremely clear. So, you know, if we have good deals, solid assets, and good structures, then yes, we deploy. Otherwise, we're not going to deploy for the sake of deploying. But that's something I would say which we've found on the market over the past 2 or 3 years. There's pressure to deploy, and mostly coming from LPs, I would say. And I've met some who are actually complaining that $2 or $3 billion or euro funds were not invested in 12 months. I mean, you can invest them in 12 months. It just depends on the quality you want them to be invested in.
So good GPs should be FOMO immune.
I mean, good GPs should take their time to invest the money. I think the market is dynamic enough today. You have enough deals on the market to be able to deploy your fund in 18, 24 months, which is, I think, what you want. So you just need to stay disciplined, and there's going to be deals you're going to want to, just decline, or you just want to leave to competition because they just don't make sense from your point of view. And then you're gonna concentrate yourself on, the deals that make sense for your portfolio.
So the trick is getting the right GPs, but also the right LPs, disciplined GPs with disciplined LPs. Like Mario, obviously, because if you have undisciplined LPs, they can push you to the limit, to the brink.
Yeah, but you see it with LPs now as well, that some of the funds just come back so fast that the deployment we haven't really counted on. So we wanted to pay into the fund again in 1 or 2 years, but they're back now. And that really messes up as an LP your whole schedule as well of who you want to stay with and where you want to invest.
Just one story about crazy GPs and LP story. I don't know if you know Tiger Global. Tiger Global, I think, raised a few billion in March and has deployed everything by October, doing 2 deals a day globally. So if you think of a 5-year cycle being your metric, other people have lined up other metrics, and obviously that's tech. But it's interesting to see how they're trying to crunch time by over deploying and therefore over receiving as well. Maybe the third factor, first factor being DCF versus backward-looking EBITDA. Second factor being liquidity and the pressure to deploy by LPs and GPs. Third factor is debt, especially on LBO. So do you want to drive us to what has changed in the debt industry over the last 2, 3, 4 years, whether on the pressure to deploy and the metrics, but also on the structures with Munir's input? Charles first.
Sure. I think on the debt side, it's like on the equity side, right? It's become more competitive, so you have more funds, you have more dry powder, so more, I would say, pressure, whether you want it or not, to deploy. So, it's translated into higher leverage for sure. Probably a turn more than 4 or 5 years ago. And I would say regardless of the industry, to be honest, you see deals being done at 9 or 10 times leverage today on software companies, for example, but even on retail, construction, or other cyclical industries, you still find leverages to be 1 turn above what they used to be. So, that's really across all the industries. So leverage is higher, pricing has lowered, but I think it's more or less stabilized over the 2 years, 2, 3 years. If you look at the margin per turn of leverage, it's been stable since 2 years in France. So it hasn't gone down since 2019, which is a good thing. Then, however, I think, and we're going to jump to Munir, but I think the difference has been in documentation. I don't know if it's because we've inherited from trends from the US or from trends from the large cap, cycling down to small and mid cap, but we have documentations that are far more aggressive than what they used to be. You can, with regards to covenants, with regards to equity cures, EBITDA cures, with regards to a whole lot of stuff.
So, Munir, can you help us? You've built a leverage practice from Asher's acquisition finance powerhouse to now Winston Throne.
Yes.
What has changed, and on the KPI, on the metrics, what has changed on the provisions?
Yeah, sure. What Charles just said is very true. During the pandemic, we've been very, especially the first half of the year, we've been very focused on the documentation, doing waivers, doing amendments to documentation to allow basically the lenders to get more debt, especially the state aid programs, and also softening a little bit the covenants to allow this.
It was called covenant holiday, right?
Yeah,
or there
exactly.
Was a term.
Exactly, but there was a trend before the crisis and after the crisis, and especially during the second half of 2020. I mean, we've seen a lot of transactions closed. We've seen many auctions, and so we've seen a lot of documentation circulating, term sheets, and this tendency of basically allowing sponsors and borrowers to relever and continuously relever during the debt period, I mean, during the financing, has been growing. All through 2020, and 2021 has also been the same. And this translated into the documentation, and mainly through, I would say, two ways. One is softening the covenant, and the other way is allowing for more debt to be an increase of debt baskets. So equity cures is the first mean, basically.
Let's get technical, please.
Let's be technical. So traditionally, in documentation, and I'm not talking about covenant-like documentation where you don't have any ratios on term loans, but only on revolving loans. But let's stick to the mid market where you still have maintenance covenants with one covenant, which is the leverage covenant. And
one thing for the record, Mounier has to be neutral because he advises both sponsors as well as banks.
That's correct. So, having said that, so if we stick on documentation where there is a maintenance covenant, and so the documentation has allowed now borrowers to cure more easily a breach of covenant. And traditionally, the way you cure the breach is you injected equity. This equity was used to repay part of the debt, pay down a little bit part of the debt, and you've cured your ratio that way. Now, documentation has shifted to a new model where the equity is not only used to reduce the debt, but it's also used as an add-on to EBITDA. And if you look at the translation on the ratio, I mean it's basically multiplied.
So it's EBITDA push-up.
It's an EBITDA push-up. So it's very different by reducing the debt and or increasing the EBITDA. The figures will be very different. And there's no more pay down of debt. So the equity is not only used to increase EBITDA, but you don't have to pay down the debt. So you can remain and maintain your quantum of debt as it was prior to the breach. Second thing is basically that you had limits on the number of times that you could go through a cure. I mean, today we've seen documentations where you only have limits on EBITDA cure and no more limits on debt cure. I mean, traditionally, and Charles, correct me if I'm wrong, but traditionally you're allowed to cure your test 4 times or 5 times during the life of the credit, during the life of the loan. Now, I mean, you only have limits on 1 or 2 EBITDA cure during the life of the loan. And also, another provision is what we call the deemed cure. I mean, for instance, if you have a breach of covenant at one testing date during one testing period.
Like a quarter.
Yeah, exactly. And the lenders, I mean, they don't do anything. They just don't accelerate the date. If on the next testing date, the breach is cured, basically you've reached your covenants, you've passed your covenant test, then your previous default,
you're clean.
You're clean. So these means of the these changes in documentations have allowed basically sponsors and borrowers to keep more debt into the transaction instead of paying down the debt. That is one thing. The second example would be the increase of debt baskets. And so, I mean, we've seen it during the pandemic, but not only the pandemic. I mean, normally, traditionally, if we want to come back to what we used to do a couple of years ago, you had fixed baskets of additional debt that you can that basically you could borrow throughout the group. That the group could borrow outside the syndicate or the main lender that has provided the main acquisition line or acquisition loan. Now, what we're seeing is that it's no longer a fixed cap. It's basically based on a certain level of ratio, and alongside of this additional debt that is no longer a fixed, you have also what we call the freebie, which is a free and clear capped basket, free and clear basket, being clear of any covenant test, any leverage test, and basically that is no longer really capped because it's half a turn or 1 turn of EBITDA, and therefore subject to a grower. If the EBITDA of the group grows, then the amount of the freebie of the basket grows also. And so this again is a way of increasing the amount of debt and the availability of debt. And not only we've added this in documentations and sponsors are pushing on this, but also the debt that is basically available on the market. You would normally, for acquisitions, for build-ups, you would normally go and see your main lender and ask him for additional debt. And sometimes he would even provide some committed or uncommitted lines that you could draw or you could have committed. But now, more and more, these additional baskets of debt are raised through what we call incremental or accordion debt, meaning that you can go on the market, find another lender, and basically bring him into the existing documentation for additional debt. And this is also something that has come from the US, basically. These are the US models that have been imported into the European market.
And do you see some European clauses that are really European specific, where Europe is ahead? I think you mentioned 1 or 2 clauses that are European native, so to speak.
Yeah, basically, if we get back to the cure, you don't see a lot of deemed cure provisions on the US
That's an
market.
EU one.
That's basically very European.
And what's your wisdom, and maybe also to Charles, about all those changes? Would you say they're getting more foolish or more wise, more smart because of the right balance of power, or more foolish because it's all about pressure and being under pressure?
I think it's not a question of being foolish or smart, right? It's just there's more pressure to deploy, there's more pressure put on us by sponsors, so you just need to adapt. And I think you need to make a distinction between the most competitive deals we see every year in France, including one, Mounir, that you advised on recently, where given the intensity of the competition, both from private equity funds and private debt funds, you really end up with very aggressive documentation. So, what Mounir was describing, we haven't accepted those things at HIG. Either you accept looking at those very competitive auctions and it's going to end up, with structures you're not going to be comfortable with, or you prefer spending time on deals and opportunities that are less competitive, where you're going to have less people, and where you're going to end up with documentations which are far better. And that includes sponsorless transactions, where I think today you get the best terms by far.
Maybe one question to you. When looking to back a deal, do you look mostly like criteria number 1, 2, 3 on the business, the fund, the management team, the debt structure?
The 4, but I think
it's a combination of the 4.
Yeah, it's a combination of the 4.
So what do you put at the top? Is it the management team first, as some say, or the fund because you have a safe pair of hands?
No, I would say management team first and foremost, because they're going to be in the driving seat, so you want them to lead the company where you want it to be in 5 years. I would say second, probably sector and structure because they're directly related. And third, probably the private equity fund.
The guy in the back room.
Yeah, but then there's a lot of other
Okay.
considerations. So that's just the top four.
What do you
what we
think?
see most domestic, I would say, most domestic funds, not because they're French funds, but because they're well established on the French market, are very focused on the management, basically, and on the sector. I would say that the debt structure it comes second.
So we've talked about what drives, backward-looking liquidity, debt availability. So then I'd like to cue in everyone on discipline. Where do you put the balance between appetites and discipline? Where do you put the red lines in your deal decision? Do you want to start or?
Sure. So I think going back to what Charles was saying before, I think we don't feel also pressure from our LPs, and we have also our own LPs. We don't put pressure on our GPs. We prefer that our GPs find the best deals at the right price. So I think that allows us to give a lot of flexibility, and if we have to decline a deal, we are fine to decline a deal. So it's very difficult to draw the line. I think it's more on a case-by-case basis, as we mentioned before, depending on the metrics, the fundamentals, the industry, the price, and then is on a case-by-case basis.
Hélène?
Yeah, I think it's the same. It's very much on a case-by-case basis, and it's about getting the returns. Sometimes you can pay a lot, but if you think you're going to get it back, if you're going to get a great return, it's fine. If you can't get there on your own forecasts, then you just can't do it.
Also, after asking Munir, if the room wants to start thinking about your questions, that will be the next step after they've answered my discipline versus appetite. What's your advice?
Yeah, I think as a legal advisor to both sponsors and lenders, I think what we need to do is to have a certain discipline. I believe that we should. What I always try to do is just to have a global analysis of the transaction, and basically the balance that between the lender and the sponsor, and depending on the transaction, you can push one way or another, depending on the economics, on the development. We were talking about development plan and what was the value versus the price. Obviously, if you believe that this transaction has a very big future and it's going to develop, then you could push for provisions that will allow and gives flexibility to the sponsor or the borrower so you have to stick to the. I think the good analysis is to have a business view as a legal advisor, to have a business view of the transaction and to adapt to the business. I mean, we very often see people who would ask for things that are not really necessary. I mean, just because they've imported things from one deal from a previous deal, from previous transaction that's completely different, which we call the precedent. I mean, a lot of people say, "Oh, we don't have a precedent," or "That's not market practice." That's what you hear all the time. It's not market practice, but okay, but the market practice should not be the only driver. I mean, the driver should be the business, the perspective, the how you want to build the documentation that can allow both the lenders and the sponsor to be comfortable in growing the business.
Charles?
Yeah.
Appetite or discipline? Dessert or no dessert?
I think discipline first, right? So, I mean, to your question, red line in debt, it's clearly the difference between putting a lot of debt on a company and putting too much debt. So that's going to be your red line, your ceiling. So you don't want to put too much debt on a company. You always want to make sure it's going to be able to service its debt during the life of the facilities, and that at maturity is going to be able, one way or another, to repay the debt. And with regards to discipline, I would say, given what you see on the market today, I mean, there's a lot of things, but the first thing is not to go too fast. And that's become hard because the processes are tighter and tighter in terms of timing. You're being called by the M&A banks asking for firm commitments in 3 weeks. So, I mean, you shouldn't do any shortcuts. You should receive all the due diligence reports. You should take the time to run your stress cases, your sensitivities, and only confirm your appetite once you know you're not going to lose any money on the deal. So I think that's the basics of discipline. And then it's just taking the time to do the good work. And I mean, with regards to what Monia was saying, creating precedents, not creating precedents, I think it's always better not to create precedents because it means there's a reason it hasn't been done before. So it's really a combination of all those things.
Maybe Sebastian, do you see, you have 30 funds who give you all the valuation work for their portfolio. Do you see a lot of wisdom or a lot of aggressivity?
But actually, what I can add, because we are not doing deals at...
your valuation are post-deal.
We are more focusing on valuation. So maybe it's not a conclusion, but I would say that all these factors or indicators is finally the deal makers. They are for each deal it's a risk assessment based on the management, the sector, the leverage, and all that. So there is many factors, and when you decide to make a deal, if you have measure your risk, and that's why you can increase the price if you think that you have keys to manage that risk. You can increase the price or maybe the leverage or whatever. But at the end, it's clearly because we are talking about finance and all that. So it's usually it's a question of risk and rentability, and we should always keep that in mind before doing a deal.
So what I hear from the panel is sky is not the limit, except in tech. Conclusion? Fair conclusion?
Even in tech, there will be some limit at some point.
Okay. So help me thank the panelists for sharing their insights.